Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at why it's time to kind of paraphrase the Beatles, give puts a chance, right? In the Dow Jones Industrial ETF, the diamonds, and the reasons why we're considering and actually put on a counter trend short trade with defined risk. As we always like to do, we use our kind of fusion approach here, combining fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, from the valuation standpoint, pulled off here is the diamonds. You can see current price to sales is 3.42, right? Combining all 30 of the components, 2 standard deviations above its 3-year average. So certainly price of sales getting stretched. PE basically right to kind of where it has been, right around that 23 level, give or take. Slightly below now, right? It's normal 23. But remember, interest rates have headed higher by far over the past 3 years. So on a comparative basis to interest rates, right, the PE ratio getting a little rich as well. So I just pulled off Goldman and Caterpillar, the 2 biggest components. Take a look at their individual price to sales ratios, right? And the weighting on both these right around 11%. So these two comprise about 22.5% of the overall index movement. So taking a look at these will give you at least a look at how things are. I pulled off a 20-year price to sales ratio on Goldman. You can see now trading at 2.2x price to sales. Not the highest it's ever been, but certainly other periods where it attempted to get higher were met with a sharp reversion, right, with a multiple contraction, right? We're starting to see that again as it hit even higher ratio, but starting to weaken. We always like for the market to kind of tell us when it's time to jump in. We don't want to really jump in from that train because being too early is the same as being wrong. But once it slows down, we don't mind taking that counter trend position. Same thing with Caterpillar, which just exploded on a price to sales basis, still over 5 times price to sale. The only time it's really ever been close to there has been the past month or so due to that recent red hot rally in Caterpillar. So certainly from a valuation perspective, diamonds and the components thereof getting a little bit over their skis here. So I think further upside certainly may be muted just on a valuation basis. We also like to look at the technicals. Pulled off a chart. Here's the diamonds going back a year. You can see that on when we saw that making new highs, right, on Wednesday, trading up to all-time highs, 546.75 intraday, but then reversing to basically close virtually unchanged. This bearish reversal pattern where you see the stock break out to even fresh new highs, reverse, and basically closed right where it opened, right? Many times a sign that the bulls are running out of steam, right? And the bears have taken charge, and certainly the price action today where we headed lower indicates that as well. You can see 9-day RSI got overbought, finally weakening, right? You can see previous times 9-day RSI got overbought, almost invariably signaled short-term tops in the market MACD at the highest level we have seen since back here when we had that meaningful top, right? Bollinger percent B exploded to the highest level by far over the past 12 months, also weakening as well. And implied volatility we'll take a look at in a second, getting pretty cheap here. We'll see just how cheap is cheap, but cheap implied volatility also sign somewhat of complacency, which is many times a contrarian sign indicating a top in the underlying. Plus, buying puts hasn't been this cheap in a very long time. So from an implied volatility perspective, pulled off here is a 60-day IV chart. You can see we're back at basically the lows over the past certainly 6 months, over the past 12 months almost, right? So certainly implied volatility has come down sharply from yesterday to today. We can see the September's, which is the puts that we're looking to buy, right? Give us enough time, but not too much, have come down in implied volatility. Here is yesterday, here is today. IV percentile only at 11%. That means options have only been this cheap 11% of the time over the past year. So certainly option prices getting cheap. We like buying cheaper rather than expensive. And compared to the historic volatility, right, or actual implied actual volatility, you can see 65%. So the market's moving, but the options are getting cheaper. You can see the September's dropped 5 vol points from yesterday to today as well. We also like to look at seasonality when it comes into play here. Here you can see I pulled off a 20-year seasonality chart for the diamonds. September, the worst performing month by far, one of the only 2 negative months. February slightly negative, September definitely negative. August, one of the worst months as well, ups only slightly. And given that rip-roaring rally we have seen so far in August, right, this big rally here, certainly looking for a pullback just based on seasonality. Then into September, there'll be a little bit of headwinds from a seasonality perspective going forward. And then pulling off, here's the Dow versus the spiders and the triple Qs. You can see back and forth action, but recently the Dow has been by far the favored index here as AI seems to be trying to die here, but we finally see some weakness in the diamonds as well. We look for that big outperformance of over the past 3 months, outperforming the SPY by over 3%, outperforming the Qs, right, by 5.5%, and many of the same components such as Apple comprise all three, so that relative outperformance even greater. So that's the reason we kind of look to go out and simply do a straightforward put buy here, buying the September 535 slightly out of the money puts. SPY closed at 538.19. You can see implied volatility getting cheap, well under 14, right, at the lowest level we've seen in a very long time, right? So spending $7.50, even a 2% pullback from here would put this trade solidly in the profit category. And then for those who say, hey, maybe I just want to, hedge it a little bit, and I am a big fan, as you know, of hedging, right? Find the edge, put on the hedge. A simple put calendar spread trade, buying the September's 535s, selling the August would reduce the costs almost $3 plus, right, to $4. That's certainly a trade that you may want to consider as well, simply to position bearishly on the diamonds, looking for that, if you will, bad hair day on a underlying that has finally shown a little bit of weakness on a technical basis, is getting overvalued certainly on a fundamental basis, and entering a seasonally very weak period for the diamonds overall. So as we always like to do, we say, just because